I need to tell you about a document that's been circulating among European finance ministries since March 2025. It's not classified, but it's not public either. A technical analysis, dense with econometric models and fiscal projections. Buried on page 47 is a sentence that should terrify anyone who understands what it means. Under current trajectory, maintaining monetary union becomes net negative for a majority of member states by Q4 2027. Let me translate that bureaucratic language into plain reality. Europe's economic model isn't struggling. It's not facing temporary headwinds or cyclical challenges. It's approaching mathematical collapse, and the people running the system know it. What I'm about to show you isn't speculation or political commentary. It's arithmetic, cold, brutal, undeniable arithmetic. And arithmetic doesn't care about your ideology or your hopes for European integration. It just adds and subtracts. And right now the numbers don't work. Here's the question nobody in Brussels wants to ask publicly. What happens when the costs of maintaining the Eurozone exceed the benefits for most of its members? Not in theory, not in abstract models, but in actual, measurable economic outcomes that affect real people's lives. We're about to find out. Because that crossover point is approaching faster than almost anyone realizes. And when it arrives, the choices will be stark, brutal, and irreversible. Let me start with something concrete that's happening right now, something that reveals the deeper crisis more clearly than any theoretical analysis. The Netherlands, one of Europe's most stable, prosperous economies, a founding member of the European project. In the first quarter of 2025, Dutch investment funds moved 87 billion euros out of Eurozone assets and into dollar, Swiss franc, and even British pound holdings. That's not a data point. That's a stampede. But it's not just the Netherlands. German insurance companies have reduced Eurozone bond holdings by 12% in 6 months. French pension funds are accelerating diversification into Asian and American markets. Italian wealthy families are moving assets to London, Singapore, and Dubai at rates not seen since the depths of the 2012 crisis. This is capital flight. Not the panicked variety you see during acute crises, but something more dangerous. Systematic, calculated evacuation by sophisticated investors who've done the math and decided the risk-reward calculation no longer favors keeping money in Europe. When I see this pattern, I don't see market volatility. I see a verdict. The smart money, the institutional money, the generational wealth that thinks in decades rather than quarters, is quietly concluding that Europe's economic model is broken beyond repair, and they're not wrong. Let me explain why the Eurozone was always going to reach this point. Not because Europeans are incompetent or because the project was malicious, but because the fundamental architecture contains a contradiction that cannot be resolved within the current framework. When you create a monetary union without fiscal union, you're building a structure that's stable only under very specific conditions. Those conditions are similar productivity levels across member states, synchronized business cycles, high labor mobility, and willingness of stronger regions to permanently transfer resources to weaker ones. Europe has none of these, not even close. Productivity divergence between Germany and Greece is wider today than it was in 2001 when Greece joined the euro. Business cycles across the Eurozone are more desynchronized now than they were before the common currency. Labor mobility remains constrained by language, culture, and regulatory barriers, and political willingness for fiscal transfers has collapsed entirely. This means the Eurozone is trying to operate a single monetary policy across economies that need radically different policies. When the European Central Bank sets interest rates, it's setting one rate for 19 different economic realities. Let me show you what that looks like in practice. In the first quarter of 2025, Germany's economy was overheating. Inflation hit 4.2%. Wage growth accelerated to 5.8%. Asset prices, particularly real estate in Munich and Frankfurt, were showing clear bubble characteristics. If Germany had its own currency and central bank, the appropriate policy response would be raising interest rates significantly to cool demand. During that same quarter, Greece was sliding into recession. GDP contracted 0.6%. Unemployment ticked up to 14.3%. Deflation pressures were building in several sectors. If Greece had its own currency and central bank, the appropriate policy response would be cutting interest rates and potentially weakening the currency to boost competitiveness. The ECB had to choose one policy for both economies. They chose something in the middle. Rates high enough to worry Greece, but not high enough to control German inflation. The result? The worst possible outcome for both. Germany gets asset bubbles and mounting inflation. Greece gets recession without the relief of monetary easing. This isn't a temporary misalignment that will correct itself. It's a structural feature of monetary union without fiscal union. And it's getting worse, not better. The divergence is accelerating. Germany's 10-year government bonds yield 2.4%. Italy's yield 4.1%. That spread 1.7 percentage points represents the market's assessment that Italy is fundamentally less stable than Germany, despite sharing the same currency. Think about what that means. If you're an Italian business trying to borrow for expansion, you're paying nearly double the interest rate of your German competitor. Not because your business is riskier, but because your government is trapped in a monetary system that doesn't fit your economy's needs. This creates a vicious cycle. Higher borrowing costs slow Italian growth. Slower growth makes Italian debt less sustainable. Less sustainable debt increases borrowing costs further. The cycle continues until something breaks, and we're watching it break in real time. Italian government debt hit 152% of GDP in 2024. That's up from 135% in 2019, before the pandemic. The annual deficit is running at 5.8%, despite theoretically being bound by EU rules limiting it to 3%. Interest payments alone consume 11% of government revenue. The Italian government is trapped. They can't stimulate growth because deficit rules prevent fiscal expansion. They can't devalue currency to boost competitiveness because they don't control their currency. They can't lower interest rates because the ECB sets rates for the entire Eurozone. Every policy tool that might help Italy recover has been surrendered to institutions that aren't designed to prioritize Italian needs. The same pattern appears across southern Europe. Spain, Portugal, Greece, all trapped in similar dynamics. Growing debt, limited growth, rising borrowing costs, no independent monetary policy, constrained fiscal policy, and capital flight as investors lose confidence in the sustainability of the model. Meanwhile, Northern Europe faces the opposite problem. Too much money chasing too few productive investments, creating asset bubbles that will eventually pop with devastating consequences. The Netherlands provides the clearest example. Dutch housing prices have increased 147% since 2015, not in nominal terms, in real inflation-adjusted terms. This isn't because the Netherlands suddenly became more productive or because housing supply expanded dramatically. It's because ultra-low ECB interest rates designed to help Southern Europe stimulated massive credit expansion in the north. Young Dutch families now need to save for an average of 18 years to afford a down payment on a median-priced home. That's up from 7 years in 2010. An entire generation is being priced out of home ownership by monetary policy designed to solve problems in other countries. And here's where the political crisis emerges from the economic crisis. When Dutch voters see their children unable to afford homes while their government sends billions in loans to Southern Europe, They don't see European solidarity. They see a system rigged against their interests. When Italian voters see unemployment stuck in double digits while Germans lecture them about fiscal responsibility, they don't see sound economic advice. They see arrogance from creditors who designed a system that benefits themselves. The resentment flows both ways. Northern Europeans believe they're subsidizing Southern profligacy. Southern Europeans believe they're trapped in a currency regime designed for Northern benefit. Both views contain elements of truth, which makes reconciliation nearly impossible. This is why I describe what's happening as controlled demolition rather than random crisis. The system is breaking along entirely predictable lines, producing entirely predictable political reactions, leading toward entirely predictable outcomes. Let me show you the capital flight data in more detail, because this is where we see the crisis moving from abstract policy debate to concrete economic reality. In 2024, net capital outflows from the Eurozone exceeded 400 billion euros. That's not total flows, which are always large. That's net outflows, meaning more money left than entered. It's the largest net outflow since the Eurozone's formation, exceeding even the 2012 crisis peak. Where is this money going? Approximately 30% to the United States, 25% to Switzerland, 15% to Britain, 10% to various Asian markets, and 20% to other destinations including gold and cryptocurrencies. What does this tell us? It tells us that global capital, including European capital, is systematically reducing exposure to Eurozone risk, not because of temporary uncertainty, but because of fundamental reassessment of the Eurozone's long-term viability. The composition of outflows is particularly revealing. It's not just hot money or speculative capital fleeing. It's pension funds, insurance companies, family offices, sovereign wealth funds, the kind of capital that moves slowly and deliberately, that makes decisions based on decade-long projections rather than quarterly returns. When this kind of capital evacuates, it doesn't come back quickly. It's expressing a judgment about fundamental sustainability. And that judgment is damning. But the most alarming aspect isn't the total volume of outflows, it's the acceleration. Monthly outflows in the first quarter of 2025 averaged 42 billion euros, up from 23 billion in Q4 2024, up from 16 billion in Q3. The trajectory is exponential, not linear. This pattern matches what we saw in the 18 months before the 2012 crisis erupted into public view. Capital doesn't flee all at once. It starts with the most sophisticated investors recognizing systemic problems early. Then institutional investors follow. Then smaller investors panic as they realize what's happening. By the time the general public understands the crisis, it's already well advanced. We're currently in the middle phase of that sequence. Institutional capital is evacuating. Retail investors haven't panicked yet because mainstream media isn't covering the story prominently. But the trajectory is set unless something dramatic changes. And nothing is changing. If anything, the underlying dynamics are worsening. Let me explain why the ECB is trapped, unable to prevent this crisis even though they can see it developing. The ECB's primary mandate is price stability, defined as inflation near 2%. But achieving that target across the Eurozone requires ignoring the fact that different member states face radically different inflationary pressures. In early 2025, inflation in Germany was running at 4.2%. In Greece, it was 0.7%. The Eurozone average was 2.4%. So technically, the ECB is hitting its target. But this average conceals a reality where policy is simultaneously too loose for some countries and too tight for others. If the ECB raises rates to control German inflation, they'll push Greece into deeper deflation and depression. If they keep rates low to help Greece, they'll fuel German asset bubbles and inflation. There's no rate that's appropriate for both economies because they're in fundamentally different cyclical positions, requiring fundamentally different policies. The ECB knows this. Their internal research papers acknowledge that one-size-fits-all monetary policy creates divergence rather than convergence. but they're trapped by their mandate and by the political impossibility of admitting the euro was a mistake. So they do what central banks always do when trapped. They buy time with unconventional policies while hoping something changes to make the fundamental problems go away. The balance sheet tells the story. The ECB's total assets reached 8.9 trillion euros in early 2025, equivalent to 76% of Eurozone GDP. For comparison, the Federal Reserve's balance sheet is 37% of US GDP. The Bank of England's is 42%. The ECB is far more leveraged than other major central banks. What are those assets? Mostly government bonds from member states, purchased through various quantitative easing programs. In effect, the ECB has become the buyer of last resort for European sovereign debt, the only institution willing to absorb the massive bond issuance required to fund deficits that exceed official limits. This creates a dangerous dependency. Member states can only fund their deficits because the ECB buys their bonds. If the ECB stopped buying, yields would spike, and several countries would face funding crises immediately. But the more the ECB buys, the more dependent member states become, and the larger the ECB's exposure to sovereign default risk. It's a debt trap at the continental scale, and everyone involved knows it cannot continue indefinitely. The question isn't whether this stops. The question is how it stops. Let me now walk you through the three possible endgames, because we're approaching a fork in the road where Europe will have to choose between bad options. The first scenario is orderly dissolution of the monetary union. Countries negotiate exits from the euro, re-establish national currencies, restructure debts, and rebuild monetary sovereignty. This would be traumatic, but it could be managed with proper planning and coordination. The political obstacles are enormous. No government wants to be blamed for breaking up the EU. The propaganda equation of euro with Europe makes any discussion of currency reform tantamount to betraying the European project. Treaties would need to be rewritten. Legal frameworks governing trillions in contracts would need to be modified. Capital controls would be necessary to prevent bank runs. But it's technically feasible. Countries could exit sequentially, starting with those facing the most severe constraints. Debt could be redenominated into new currencies based on legal frameworks established during exit. The EU could continue as a political and trade framework even without monetary union. The economic disruption would be significant but temporary. Countries would regain policy tools to address their specific conditions. Productivity would gradually realign as exchange rates adjusted to reflect actual competitiveness. Within 5 to 10 years, economies would stabilize at more sustainable levels. The second scenario is chaotic collapse. Some triggering event, a sovereign default, a banking crisis, a political upheaval, causes a disorderly breakup where the monetary union fragments in panic rather than through negotiation. This would be catastrophic. Bank runs across multiple countries simultaneously. Capital controls imposed in emergency conditions. Massive wealth destruction as assets are redenominated unpredictably. Potential breakdown of payment systems. Severe recession across the continent. The comparison would be to Argentina 2001 or the Soviet Union 1991, state structures unable to maintain order as economic systems disintegrate faster than new frameworks can be built. Months or years of economic chaos before stability returns. The third scenario is technocratic authoritarianism. The EU responds to crisis by centralizing power, moving toward fiscal union imposed from Brussels rather than negotiated by member states. This would involve giving European institutions direct taxation power, direct control over national budgets, and ability to override national democratic processes in the name of economic stability. This is actually the preferred solution among many EU elites. They view the current crisis as proof that more integration is needed, not less. They want to complete the project by creating a true federal European state with centralized economic governance. The political obstacles here are also enormous, but different from scenario one. This requires convincing voters in wealthier countries to accept permanent fiscal transfers to poorer regions. It requires voters in poorer countries to accept permanent subordination to Brussels technocrats. It requires abandoning national sovereignty over taxation and spending. Most importantly, it requires believing that problems caused by centralizing monetary policy will be solved by also centralizing fiscal policy. That's a harder sell after the euro's demonstrable failures, but it's the direction European elites are pushing. I need to be clear about which scenario I think is most likely and why. Orderly dissolution is the economically optimal outcome, but requires political courage that's currently absent. No major political party in any member state is willing to campaign on euro exit, despite growing evidence that exit would benefit their citizens. Chaotic collapse is increasingly likely as time passes without reform. The longer the current system persists, the more unstable it becomes, and the higher the probability of some shock-triggering disorderly breakup. Technocratic authoritarianism is what European elites will try to implement if crisis creates the political opportunity. We saw this pattern during the 2012 crisis, when emergency conditions were used to impose austerity and structural reforms that couldn't have passed through normal democratic processes. My assessment is that we'll see elements of all three. Some countries may negotiate exits, others may be forced out by crisis, the remaining core may attempt deeper integration. The Eurozone of 2030 will likely include fewer members than today, with more centralized control over those that remain, having gone through a period of severe economic disruption to reach that configuration. The tragedy is that all of this was predictable and predicted. Economists warned before the euro's launch that monetary union without fiscal union would create exactly these dynamics. The warnings were ignored because political will for integration overrode economic analysis. Now we're paying the price for that decision. And the price is measured not in abstract policy failures, but in lost growth, unnecessary unemployment, damaged careers, disrupted lives, and rising political extremism across the continent. Let me give you some numbers that illustrate the human cost of this failed experiment. Youth unemployment across the Eurozone averaged 17.3% in 2024. In Spain, it was 28%. In Greece, 32%. These aren't temporary cyclical numbers. These have been elevated for 15 years. An entire generation has come of age knowing only economic insecurity and limited opportunity. The cumulative GDP gap, the difference between actual economic output and potential output if proper policies had been implemented, exceeds 3 trillion euros over the past decade. That's 3 trillion in goods and services not produced, wealth not created, innovation not pursued because of policy constraints imposed by monetary union. The emigration data is equally telling. Since 2010, Greece has lost nearly 500,000 working-age people to emigration. Portugal lost 300,000. Ireland lost 200,000. These are the youngest, most educated, most enterprising citizens, the people every economy needs for growth and innovation. They're leaving because the economic model offers no future. Meanwhile, political extremism surges. Far-right parties now govern or participate in governments in Italy, Netherlands, Finland, and Austria. Far-left parties have made significant gains in Spain, France, and Greece. The political center that built and sustained the European project is collapsing because the economic model it created is failing to deliver prosperity. This isn't coincidence. Economic insecurity breeds political extremism. When mainstream parties offer only austerity and structural reform as solutions to problems caused by flawed monetary architecture, voters turn to alternatives that at least promise change. The European establishment blames Russian disinformation or social media or populist demagoguery for the rise of extremism. But the real cause is economic. a generation of young people with no prospect of matching their parents' living standards, trapped in a monetary system that prioritizes creditor rights over economic recovery. As long as that system persists, political radicalization will accelerate, and the window for orderly reform is closing faster than most people realize. Here's what keeps me awake at night. I see European leaders who understand these dynamics but feel trapped by political constraints from acting on that understanding. I see millions of Europeans whose futures are being sacrificed to maintain a currency union that serves no one's interests. I see capital fleeing a continent that still possesses enormous human capital and technological capability, but has locked itself into a policy framework that prevents utilizing those assets. Most of all, I see time running out. The mathematics of debt, the psychology of capital flight, the politics of resentment, all are accelerating toward crisis. And when that crisis arrives, the options will be worse than the options available today. Europe can choose orderly reform now or chaotic collapse later. It can negotiate managed transition to more sustainable structures, or it can wait for markets to force brutal adjustment. It can act while still possessing some control over outcomes, or it can wait until events control it. Current trajectory suggests waiting is more likely than acting, and that waiting will prove catastrophically expensive. The document I mentioned at the beginning, the one circulating among finance ministries, concludes with a recommendation: begin technical preparations for multiple contingencies, including coordinated exits from monetary union. Even the bureaucrats can see what's coming. The question is whether political leaders will act on that analysis before mathematics forces their hand. Based on observed patterns over the past 15 years, I'm not optimistic. Europe is not facing temporary policy challenges that better management could resolve. It's facing mathematical inevitability arising from structural contradictions built into the Eurozone's foundation. Those contradictions are now generating costs that exceed benefits for a growing number of member states. And when costs exceed benefits, systems break. That breaking point is approaching, not in decades, in quarters or years. The capital flight data shows sophisticated investors already positioning for that outcome. The question for everyone else is whether to wait and hope or to prepare for what's coming.